Before we get started, just a quick note, if you are hiring in crypto, you should check out Campus. Out of all your candidates, it will help you pick out the real crypto natives. Head to theblock.co/campus to get a 3-month free trial. Now, today's episode is about yield basis. Now, Michael, obviously you're very well known for Curve. It's a very big project in the space. You're now building something new that's sort of adjacent but intertwined. So can you explain to the audience what is yield basis?
Right. So, well, um, if you want to say briefly, yield basis is a project which eliminates impermanent loss. But for those who don't know what impermanent loss is, because I can believe there are plenty of such people, I would say that it allows you to essentially bring your crypto, starting with the wrapped bitcoins essentially, and earn yield on that derived from volatility of this crypto. So that's something which DeFi dreamed about for quite some time, but it wasn't so easy to implement.
Okay, cool. And then can you break down like exactly how it works? So like what would be the benefits of using yield
Right.
basis and
Yeah. Well, I guess I first should say what impermanent loss is, because it was. I'm not sure if it's a good term, but it was coined at some point in time in early DeFi. Basically, imagine that you decided to provide liquidity and earn something from volatility of cryptos, right? And well, the simplest you can do is to put liquidity in Uniswap 2, but now it's 3 and 4, and on Curve as well. And all of these pools are affected by impermanent loss. So what actually happens if you provided liquidity and crypto goes up, your AMM obviously sells this crypto and has less of it. So it's less exposed to the growth of crypto than it would originally be. Or if crypto goes down, then it buys more of this crypto, and you're more exposed to the fall of this crypto than if you did nothing. And then it appears that earnings in the AMM usually don't cover the difference of like what you would have if you did nothing and held your cryptos and stable coins, and if you put that for work in AMM. So the result appears to be very strange. If you put funds to work in AMM and let's say Bitcoin and US dollars, and Bitcoin goes up, then you end up with less funds if you have them in AMM than if you have them doing nothing. Of course, maybe that's not the case if Bitcoin price goes back to where it was, but usually it doesn't. Usually cryptos have a tendency to change price for a long time, if not forever. And that's why crypto liquidity in DeFi is not as big as one would think. So, well, Curve itself, it got popular mostly due to stablecoin swaps, where this problem is not a problem, because, well, if you swap USD to USD, then price of your liquidity is USD plus the fees you've made on the way, and you just have no losses here. But if you swap between crypto and USD, you essentially have this problem. And how yield basis solves it? Well, I would say that this problem was tried to be solved for quite some time. Maybe the first ones to try were Bancor. They what they did, they printed token emissions, BNT emissions, to cover this impermanent loss, and took the fees for the system. Well, apparently this doesn't quite work, because even token emissions cannot cover this kind of loss. So they had to close this feature. Well, another way was tried by, I think, Open. They made something called Squeeze, which is an option which matches their impermanent loss profile. And I think the same thing, more or less, is tried by Gamma Swap. Well, in concentrated liquidity realities, though. But the problem there is, how do you bootstrap liquidity? How do you find the other side to sell you this option? And well, it can be useful for some speculators, but it appears that it's actually fairly hard to bootstrap the other side. And yield basis does it differently. So imagine that, well, imagine liquidity in Uniswap 2 or in Curve, which, although Curve has a different AMM, it has concentrated liquidity, which is automatically managed. But impermanent loss in Curve crypto pools is the same as in Uniswap 2. And what it comes down to essentially price of your liquidity being proportional to square root of crypto price if you pair crypto with stablecoin. What actually causes this impermanent loss is this square root dependency. It's non-linear and it's like growing slower than linear at all times. That's the problem. So what yield basis does, we actually do 2x leverage on LP token. But this 2x leverage is compounding leverage, which means that you keep your, you borrow against your LP token, and using the borrowed funds, you buy more of this LP token to have the LTV ratio always around 50%. If crypto goes up, then your liquidity becomes more expensive and your LTV drops below 50%. It means that you need to borrow more and buy more liquidity until it's 50% again. Or if crypto goes down, then it appears that your LTV is bigger than 50%. Well, that's not good, so you need to take a little bit of your liquidity and sell it to repay some of the debt to have it again 50%. Then you get to what is called compounding leverage. And the magic is, if you apply compounding leverage to absolutely anything, then the price of position with compounding leverage is proportional to square of the price of what you put in this leverage box. And well, what we put there is liquidity token, which has price proportional to square root of crypto price. So square root squares, and then it square root disappears, and you have just the position proportional to crypto price plus the fees it's making. Well, that's the brief idea. It appears that it's not so simple. So, for example, if you do this trick to actual Uniswap 2, you wouldn't actually be making money. But if you apply it to Curve crypto pools, which do have auto-managed concentrated liquidity, then it does work. So it appears that concentrated liquidity is actually important. And well, there are a few other things we had to do to Curve crypto pools, though, to make it work.
Yeah, interesting. Like, it takes me back the first time I sort of discovered impermanent loss. Well, at first I just didn't understand it in the slightest. But this was at the time when Pancake Swap was like at its heyday, and I just kept trying at like small bits of money in these different pools until I eventually lost money, and then I understood how it worked. And you brought up Squeeth. I've had like a tiny position in Squeeth. I still don't fully understand it, but
yeah, it's hard to understand actually.
Yeah, I think I had not enough that was worth the gas fees of selling it at the time.
Well, I mean, it was good for test, I guess.
So actually, I have a question on that with respect to impermanent loss. Can you speak to the almost like the unicorn scenario where you actually have positive impermanent loss and when these types of situations occur?
Oh, positive impermanent. So impermanent gain, you mean?
Excuse me. Yes.
Yeah, you actually can. You actually can have impermanent gain, and that is what you have. What you interestingly have in Curve in CRV-USD. When you borrow CRV-USD, there is a mechanism which does smooth liquidation and deliquidation. So when, let's say, your crypto goes down, then the algorithm, the AMM, converts it gradually to CRV-USD. And if it goes back up, it converts this CRV-USD back to crypto. So, and it appears that if you draw it as bonding curves, then you actually have something you can call impermanent gain. But the problem with that is that if you have impermanent gain, you actually also have a little bit of permanent loss. So you, well, if the price comes, kind of goes through this liquidation range and then goes up and you get deliquidated back to the same price, it appeared that you actually lost a little bit. But if it ends up with in a price very different from the beginning, like either down or up, then it appears that you had, well, that you had something like impermanent gain. So it's, well, but yeah, that's interesting. And here you also kind of have, well, kind of have impermanent gain if you leveraged Bitcoin, but it would be a leveraged token then. But here we are leveraging liquidity, so we want to not use it for leverage, but to use it to actually remove this annoying square root dependency. But actually that same AMM can be used to make leverage tokens like Bitcoin 2x, Bitcoin 3x, Ethereum 3x, and whatever.
Okay, so just sort of like break it down a little bit for those listening, because the whole square root stuff's pretty complicated. So basically you're saying that if someone has like 200 grand of Bitcoin, just to use the example from your docs that I read earlier, instead of selling like 100k of that for dollars and using, you know, essentially half and half to supply liquidity on both sides, you're saying that essentially they almost keep all of their, well, they do keep all of their 200k of Bitcoin, but they essentially take out a loan for half of it in essentially dollars and stablecoin in order to provide the liquidity on both sides without selling and sort of losing the exposure to their initial full capital. Sorry, am I getting that about right?
I guess so. Well, in a sense, yeah. So you essentially have exposure to, well, exposure to Bitcoin price, but that's about it. Plus, well, plus of course the fees you want to earn.
Yeah. So if you're like taking out a loan as sort of a core part of this, what are the risks to doing that?
Right. So, well, it's not you, of course, who are taking the loan. It's the system, and because LTV is 50%, and you take it against not Bitcoin, for which 50% is already kind of safe, but against liquidity token, then risk is not very high, but risk is, and you don't have liquidation risk actually because you are deleveraging on the way down, so you don't count to liquidation. But there is a risk. The risk is if crypto changes price very, very quickly, like, I don't know, by a factor of 2 in like seconds, and stays there changed by a factor of 2. That's that wouldn't be good. That doesn't happen to Bitcoin. Bitcoin is very stable in this sense, and to Ethereum actually also doesn't quite happen. But that seems to happen to some, you know, some altcoins or to some meme coins and whatever. They are not great to use in yield basis, so we need to use major assets due to that. And if the price changes not by that much, but still stepwise, like let's say price changed by 3% instantly and stayed there, or really changed by more but a little bit faster than you would expect. Well, that happens, right? So if this changes too fast, then you would have some partial loss. So in simulations, I see that during FTX collapse, if you applied yield basis methodology to Ethereum, you could have had, I don't know, maybe 5 to 10% partial loss, which you would well, earn back in fees in some time, but not instantly. So this is something you kind of want to avoid. With Bitcoin, it's actually not the case. With Bitcoin, it appears that such events did not happen recently. They probably happened much earlier in Bitcoin's life when it was a less mature asset. And I think with major cryptos, with institutional adoption, the volatility actually goes down, which of course somewhat decreases the fee earning potential for yield basis, but increases safety.
Now, if you're having to sort of, or if the system is constantly rebalancing your portfolio in order to make sure it's adjusting value parameters and things like that, is there a cost to that in terms of it has to make quite a lot of transactions?
Well, it's not
and then also, is there a cost to taking out the loan?
Well, it's not the system who is making the, well, it's not like some trader who is doing rebalances or re-leverage to keep the leverage constant. But these are special AMMs, and you have essentially arbitrage traders doing it for you. And the cost, especially for keeping leverage constant, for the compounding the leverage part, there is a cost associated with profits, which arbitrage traders take for themselves, and gas price. And gas price is actually something which is significant while the system is still small, right? So when it's small, then transactions which change the leverage are small as well. And the gas fee appears to be a more significant part of that, and that, well, obviously profit, which arbitrage traders make, should be larger than the gas cost, and that's something they take, and liquidity providers essentially pay. So that's something to keep into account, and that was accounted for. But yeah, it's something I had to do simulations with.
So it's interesting you speaking to some of the stress tests for these products, and like the FTX example was really, really cool for you to highlight. One of the things I'm curious about is maybe some people you spoke to DeFi being a bit small just because it's a bit complex. There's some concepts even in crypto most crypto natives don't understand. Who is this product geared towards? Who should be utilizing yield basis?
Right. Well, I don't think actually DeFi is not super large because it's complex. I think it's not because of that. I think it's because there is some certain size of each opportunity in DeFi, right? And there is a certain opportunity in like asset swaps. There is some opportunity in volatile pair swaps, and there is some opportunity in lending, right? So it appears that, well, right now crypto is attracting fairly smart people from TradFi, and things which generate good yields, they grow, right? Good natural yields, right? So like swaps, like stablecoin swaps are kind of close to saturation point, I would say. Lending is probably far from that, but crypto swaps are very far from saturation. They just have this weird problem of impermanent loss. And well, if you, how big this is a good question, of course. One limit is how many people want to earn yield on cryptos, and I think the answer is quite many. You can get probably some several hundreds of $1 billion essentially. But this is not the opportunity size, because apparently if you try to make any source of yield, right, and if you try to scale any source of yield, this yield starts going down at some point due to whatever reasons. Well, if you do it for stablecoin swaps, then the yield starts going down due to well, some demand for stablecoin swaps being finite. If you do it with lending, then yield also starts going down because you you kind of get less and less people who want to use these loans to leverage or to borrow against crypto or whatever. So you have a certain amount of people who want to borrow against crypto. Right now we have quite many, looks like. And with crypto swaps, I think the fundamental limit is people who want to swap cryptos. So how to find where this limit is? I think one needs to look at liquidity on exchanges, but not total liquidity, but let's say liquidity within plus minus 2% price changes. I think there is such a metric. And by matching that to yield basis, I try to estimate where the limit is, and I think it's somewhere between, I don't know, 50 and 100 billions maybe. So you at that point, let's say 50 billion TVL, right? Yields will probably start going down, will probably start saturate because, we would have too many swaps going through yield basis because liquidity is huge, and when liquidity is bigger, then price fluctuations are smaller and you extract less from those. So the big liquidity would suppress short-term fluctuations of the prices of cryptos.
Understood.
And that's what will get the yields reduced, and that's when the saturation point will probably be reached. I don't know, maybe it will change over time what this size is, because it depends on crypto market cap, it depends on what in which season the market is, in which part of the crypto cycle or whatever that is. But there is a limit which is probably lower than the demand for yield. Demand for yield is actually high for anything, but it's, if you ask people what's if you try to measure what's the demand for yield, well, I would say up to 10% you get one number, up to 5% it's another number, and so on. So anyway, this equilibrates at some point with this demand for yield and supply of yield, and yeah, so I think we will have some equilibrium there, but what it exactly is, nobody knows before it is reached.
Understood. Yeah, and well said. I think one question that I had kind of as you were talking through that point was, until we reach that saturation point, let's say the lower end of 50 billion like you defined, do you think this changes the conversation around real yield around these major pairs? I know it's a popular discussion ongoing in Bitcoin as well as Ethereum.
Yeah, of course. So it can be totally applied to Ethereum. And I think it will. So we will have extra yield on Ethereum in addition to staking. And but there is saturation point for Ethereum as well. And then the question is, can it be applied to more assets? So I probably wouldn't apply it to stocks, because they seem to have this weird tendency of changing price instantly by a factor of 2 or something. They can do it. But maybe, I don't know, maybe earning yield on gold would be something to check if it's feasible, right? So I wouldn't mind to have a brick of gold which grows in size every day.
It sounds like alchemy. That's awesome.
Yeah.
So why are you focusing this on Bitcoin primarily, which isn't a sort of particularly DeFi native asset?
Well, it's just for a start. I think there are a couple of reasons. One is Bitcoin price seems to be probably the least volatile of cryptos, and in simulations at least it shows that it's probably the safest asset for this method. So makes sense to start with that. And also the demand for yield on Bitcoin seems to be fairly good. So we can, one other interesting point is that on curve, Bitcoin is probably, well, it is bigger than Ethereum as collateral for minting CurveUSD. So CurveUSD is more backed by different Bitcoin wrappers than by Ethereum somehow.
Yeah, it's interesting because I saw you mention that yield basis uses CurveUSD quite significantly in a way that could drastically sort of boost its supply. How beneficial is that to sort of grow its supply? Because I mean, we had Mark Zeller on here recently saying about how Go is so much more profitable than like deposits on Aave, for instance. So it's a big focus for them.
Right. Well, that's a good comparison, I would say, because in a typical CDP, well, which Go is and which CurveUSD normally is, you have of course demand for borrows, right? But then the question is, where does this stablecoin go? And it actually gets, when somebody borrows a stablecoin, they are going to sell it immediately. Whether they leverage, if they leverage, then they buy, they sell this stablecoin for more crypto. If they buy it to spend, they probably will convert it to USDC or USDT, which they will ramp out and use this money for something. So they sell what they borrow, and selling, of course, reduces the price. Well, it creates a downwards price pressure on stablecoin. Of course, this would create a DPEG downwards until they repay, which is too long. So you need someone to hold this stablecoin before they repay, which means you need a supply sink. Aave is currently incentivizing Go supply sinks, and in Curve we've made the savings CurveUSD, which is like a yield-bearing CurveUSD, which seems to do fairly well, but still it's this issue of having a supply sink which matches the borrow part is a problem, which prevents CDPs from growing too fast. So you need holders of the CDP to match the borrowers. Otherwise, it doesn't work. So it's still working like lending and borrowing in this sense. When you use yield basis, then of course you borrow, yield basis borrows some CurveUSD against liquidity. But what does it do with this CurveUSD? Imagine you brought 100K worth of WBTC and you borrowed 100K CurveUSD. You take both of them, make them together in an LP position and put that as collateral. So your LP position appears to be also a supply sink for CurveUSD, which you just borrowed. So net price pressure on CurveUSD from that would be zero, which means that unlike introducing more and more collaterals to CurveUSD, yield basis is actually different because it goes together with supply sink for the same CurveUSD, and this doesn't create this scaling bottleneck.
And, would you say that? Go on, so did you want to answer?
Yeah, I think you asked how good it is for Curve, essentially, right? Or for growing CurveUSD or whatever. So of course it would grow CurveUSD supply, but this is not what Curve will make money from. One thing Curve would make money from would be having some token allocation from some YB tokens going to Curve to be used for whatever. And I think the good way to put that to use for Curve would be to incentivize, to buy votes for CurveUSD stablecoin pools like CurveUSD USDC, CurveUSD USDT, and so on. And another one to arbitrage these yield basis, yield basis related pools. One would need to swap between, wrapped Bitcoins and CurveUSD. But when somebody arbitrages, they need to arbitrage with something which doesn't have curve USD typically, maybe with something which has USDT or USDC and so on. Um, and that that would need to involve a stablecoin swap between curve USD and USDT or USDC, right? And these swaps they happen on a curve, so they leave fees to curve, and these fees appear to be fairly big. So I estimated total, well, actually just yesterday, I estimated total value which will be left on curve in this case. Well, stablecoin swap fees plus the YB tokens, and it appears that it's actually not too small at all. It would be well, probably comparable to what yield basis itself makes from these fees for the EYB holders. Well, like maybe half of that or something. So it's a pretty good deal, I would say.
Would you say that yield basis is aimed more at the casual user or the very sort of experienced DeFi native?
Well, I think it's actually much easier to use than Curve, in a sense, because we are not going to have boosts. That makes it simpler. You can choose what if you want to earn YB tokens or if you just want to have Bitcoin auto compounded. So then it just comes to depositing and withdrawing. That's it. You don't really have to do much more stuff. Of course, if you participate in governance, you need to be quite a bit more thoughtful. But for LPs, it's actually rather simple, I think.
Have you ever thought about making Curve itself more sort of accessible to people, less crypto native? Because I've always thought whenever I've looked at the UX, you know, even if you just go on the site and you see just like MSUSD/Frax BP, and if you're kind of new to crypto, it's a lot of letters that you just might not have anything to.
I know, yes. So I think the answer here is to have products which choose whatever stable coins for you and you just deposit something, but it would be another project on top of low-level protocols, because like there are low-level fundamental protocols and there are products on top of that which make it more accessible. So that's...
So would you like to see other projects building on top of Curve?
Oh, there are really many, so I couldn't even remember all of them, but yeah, so there are plenty of them. It's probably even, well, they usually build on top of multiple DeFi protocols, so they just put funds into whatever the most profitable safe strategies are.
Cool. And is there anything new coming to Curve anytime soon?
Yes, so actually something kind of connected to yield basis. Yield basis requires certain update to crypto pools, which essentially allows to connect an external stream of funds to invest in reconcentration of liquidity in the pool, right? And this appears to be fairly necessary for yield basis, but also it allows to create swaps between, I don't know, different stable coins of different fiat currencies much more efficiently than it was done before. Of course, I mean, so of course there are, well, you can create a narrow range on Uniswap 3, but you will suffer from, again, impermanent loss with a very amplified rate, right? So here you can minimize that to probably something, something similar to impermanent loss in XYK pool, essentially. But at the same time, you would be probably 50 times more concentrated than XYK pool, which appears to be perfect for foreign exchange pairs or for, I don't know, for gold or something like that. So we probably would explore applications of that, but the implementation which allows to do it is already in voting in Curve governance.
On a bit of a different note, I was actually kind of curious about overall demand for yield basis. It was interesting to see that it was reported that the fund was oversubscribed by about like 15 times. So, why is there so much demand for yield basis, and like where's the demand coming from?
Right. Well, I think it's we tried to find different parties like I don't know people, funds, Bitcoin miners, whoever, to who want to find yield on their Bitcoin, right? And we wanted to get them aligned with yield bases to essentially squeeze them in all in one little round. We succeeded in that. So the idea was to create this alignment, but if we really wanted to, we could make one of those high FDV rounds, which I don't particularly like, so we chose to not really do that kind of route.
Understood. And I guess when are you hoping for this to go live?
Very, very soon, I would say. Yeah, I think you probably can feel that if you watch, I don't know, yield basis tweets or Curve governance proposals.
Understood. And then one last thing I was kind of curious about, if you could tell us more about your learnings from Curve, one, DeFi innovations, and then how that led to inspirations for
Right.
actually building and creating yield basis.
Yeah, so I think one of good learnings from Curve would be with regards to VE tokenomics, because well, we obviously learned that VE tokenomics is great, so I will use that in yield basis as well. But at the same time, um, I would say that um, boosting, which we had in Curve, like when locked tokens boost, when they boost um, token APR in liquidity pools. That thing is probably not a great thing because eventually it leads to concentration of power in very few entities, which appear in Curve case appear to be Convex, Stake DAO, and YEarn, which is not necessarily too bad because they help Curve greatly, but nevertheless, it's kind of less of immediate decentralization. Although those projects are decentralized, of course. So anyway, I wanted to see what happens when boosts are not not applied. And another thing is something I saw in Convex. So in Convex, they actually split. They split between users who want to earn CRS, who want to earn USD, and who want to earn volatile tokens when you earn these from CVX CRV. So you stake CVX CRV and earn system fees, right? And if you can choose to earn any within any proportion, some USD and some volatile tokens like CRV and CVX. And most people choose either to earn CRV and CVX or to earn all USD. So, and I thought, why not apply this principle in yield basis? So liquidity providers in yield basis would be able to choose whether they want to earn real yield or they want to earn YB tokens. So you can earn one or the other. And this leads to really interesting consequences like dynamic inflation, which adjusts with where the market is without actually having to look at any prices or any centralized controls. Or it leads to dynamic admin fee, which is when everyone wants to earn YB token, then admin fee of the system will be dynamically increased. So that's something which just follows from this design.
Okay, now I wanted to ask you, like, DeFi sort of had its heyday, I want to say maybe around 4 years ago with sort of DeFi summer. Over the last few years, there's been, a lot of focus on Solana, a lot of focus on meme coins. What's it been like just sort of heads down, staying focused on sort of Ethereum DeFi this whole time and sort of ignoring like a
Right.
lot of the rest of it?
Well, uh, I would say it's probably something which has to do with with all the casino things being very, very far from what attracts me. I just don't accept meme coins as something worthy at all, as well as NFTs, like collectible NFTs at least. So that is something I never touch. And well, this is essentially the only thing which was happening on Solana. So, I mean, Solana tries to change now, but whether that will be successful, I don't know, because they onboarded all these speculators who just want to speculate, and they just want casino assets. But this is kind of very, very far from what is naturally attracting me.
Interesting. Why don't you see any sort of value in meme coins?
I mean, yeah, they don't hold any fundamental value by definition, right? So, I mean, of course, you can argue that they, I don't know, attention coins, whatever, right? And in a way, Bitcoin is the ultimate meme coin because it's, well, at least meme coin part of it is what made it store of value. But I somehow don't think that meme coins will repeat the path of Bitcoin. They would rather be just speculated and go to zero, just like multiple altcoins like Bitcoin forks in, I don't know, in some 2014 or something.
Who knows?
Yeah,
Maybe
you
we
might.
could get Murad to change your mind.
I was gonna say, I think you two, you and Murad would struggle to have a conversation. It'd be sort of like different language games. Like, just would see everything so differently. Yeah, we had him on the podcast recently. He's very much of the idea that meme coins have these sort of fundamentals. And then you've obviously sort of been very successful in crypto. What motivates you to keep going?
Well, I would say that some problems in crypto are not yet solved. So if I can solve it and they they are not solved yet, then I just keep going.
What are the sort of biggest problems you want to solve? I mean, obviously, impermanent loss is one we spoke
Well,
about
impermanent
today.
loss. Well, I mean, if I see something, I do it and see what happens.
Is there any other problems on the horizon, or is that the only one?
Well, I think the one which I was trying to tackle is liquidation. So I made it reversible in Curve USD. Well, of course, the issue is that it's apparently hard for people to grasp that liquidations can be reversed. But I think with impermanent loss, it's a little bit simpler because you don't really have to say it's impermanent loss. It appears just wrapped as a yield-bearing crypto, which everyone understands.
Yeah, and you've obviously been around in crypto for a long time. How would you say the sort of current state of crypto is? Like, do you think we're doing a really good job in terms of sort of the overarching goals, or would you say it's sort of a low point for crypto? Like, do you have a view?
Well, I would say that crypto is being very, very well promoted to institutionals. So they are, well, so adoption over there happens really fast, which is great. But at the same time, crypto somehow goes a little bit away from decentralization. So it's somehow normalized that projects can have multi-sig governance, which I think is nonsense, right? So I mean, they can, but like it's a fairly centralized thing, and well, it means that there are inherent risks here. You probably have seen few multi-sig rugs, and it can happen even more. And well, I mean, it of course plays well with institutional adoption. They would say that, okay, why don't you multi-sig several institutions and that's it, and let's call it a day. But it's fairly far from really permissionless and hence borderless finance, which DeFi is.
So
What
on
would
that
you
note, I was
say?
actually kind of curious. Was there anything that since you started building Curve back when DeFi was just starting to take off to now, that kind of surprised you with respect to innovation within crypto and specifically DeFi?
Yeah, well, I think there were plenty of surprising things, but yeah, I think one thing which always surprises me is that um, speculators always want to gamble on something worthless, and then they of course then try when it goes to zero, and then they try it again and again, and this is a fascinating pattern. This is something how I see meme coins actually. Um, so, but anyway, I think that's what it is. And of course, there is a fundamental part of the crypto which doesn't go away ever, which is something I'm trying to build along. But yeah, sometimes we have one hyped thing replacing another and another. So we had restaking, which I don't know where this narrative is right now. Like, is it still any hot at all, right? But it was
I
kind of
wouldn't say
clear.
so.
It was kind of clear that this is probably not gonna fly right now or ever. Well, maybe it will fly sometime in the future, but it's not easy to bootstrap this concept actually.
So you speak to the fundamental. Oh, sorry. Again, my apologies.
Yeah. Yeah. Well, anyway, go on. Yeah.
I was just kind of curious then. You speak to honestly like almost like folks needing to pay more attention to fundamentals in crypto. What's the area that you believe is fundamental that deserves more attention? People should be focused on building for right now.
Well, I think fundamentally it's DeFi, right? What else in crypto is as important? Of course, there is. Well, the original vision was that crypto is Web3, right? So we had Web 2 and now we will have Web 3. So we have decentralized internet, decentralized applications, and so on and so on. It doesn't seem to be happening this way, right? Everything worthwhile in crypto seem to happen around some sort of finance. So I think it's not Web3, it's money too, right? So we have programmable money, which don't depend on any third parties at all, and you are always self-custodying those money. So there is no middleman. This literally never happened before in human history. This is why it's so huge.
Understood. Yeah, it makes a ton of sense. I guess, Tim, was there any other questions you had? Otherwise,
Just going to ask if you had any view on the digital asset treasury companies that are sort of stockpiling Ethereum, obviously as well as other assets. Like, do you think they're good for the space or a bit of a risk?
Good question. Depends on how they do it, right? So if they make, I don't know, if they make leverage, right? If they leverage everything, then it's there is some risk, of course. But if they just serve as a legal wrapper for crypto to make it accessible to those who didn't have access to crypto before, well, I would say it's unbanking the banked, right?
Yeah.
In this sense, it's good. So
Yeah, and are you going to get strategy using yield basis?
well, I mean, it would be good, I guess. I can see that happening in principle, but then of course these companies need to be allowed to legally use DeFi. I think treasury companies can do it, but ETFs probably cannot. yet. So yeah, we will see.
Awesome. All right. Well, that's all we have for time for today. I want to thank Michael for joining this episode. And as a reminder, our newsroom works tirelessly to get you accurate, informed crypto news if you want to stay ahead with the block. Thanks, and see you next time.